a lot of things that can change the value and price of a property. Nobody could predict COVID. No one predicted the interest rates jumps. There are people in much worse shape because they were not figuring in that cap rate expansion that you're talking about. So the average person, when you sell a property, you're figuring a cap rate expansion of, like you said, 10 or 20 basis points a year. There are many people that didn't do that. So they're in much worse shape. And that's one of the reasons why some people just turning in keys. There's been a lot of foreclosures in the past few years of large multifamily assets.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey everybody, welcome back to this week's episode of Ironclad Underwriting Podcast. And I got my awesome, he's not a co-host, he's just a recurring special guest, Frank Patalano. How are you doing today, Frank?
We're having a good day so far. Obviously, ups and downs in real estate right now. So hopefully we can figure a few things out to make it easier.
Yeah, we just went over a quick deal that should be posted to probably my YouTube channel. So if you want to check us out on how we just go through deals, check out my YouTube channel. But that's not the topic of today's podcast. Today, I wanted to discuss an issue that we are currently facing and an issue that many people are currently facing. And that is we have a loan that matures at the end of the year, and we are trying to refinance out of it. But there are too many things going on that are affecting this. And this is including cap rates are expanding, at least in the market we're looking at. We did underwrite some cap rate expansion. I think we estimated maybe 20 basis points per year. So if we did that, and this was 4 years ago, so we would think that the cap rate would be 0.8 higher, 0.8% higher. But actually, we are looking at cap rates that are 1.5 times higher, or 1.5% higher. So we bought a property at a 5.25 cap, and now we are getting valuations at a 7.25. So actually up to two points. What do you think about that?
I mean, cap rates are not directly related to interest rates, but both of them are showing someone the return on their money. So if interest rates go up by 300 basis points, thankfully cap rates did not go up by 300 basis points. By the way, how much did interest rates go up in those years? 200 basis points?
Well, I mean, when we bought this property, we ended up getting bridge debt, and we were looking at 5.99%, which was ludicrous back then. Then all of a sudden, interest rates skyrocketed, and then 5.99 was actually better than any rate that we could have gotten since. And this was back when interest rates were typically like 2 to 3% for agency, and 3 to 4 for like bank debt. And we got it at bridge debt at just under 6. Now bridge debt is 9 to 11%. I think that's what we got quotes on for this property, just because we're trying to figure out a loan product. And so it's like, for us to get agencies, we're still looking at 5.5 to 6.25%. So I mean, our interest rate may actually go up, causing us to have higher debt service every month, but like we won't get any of the benefit of like a cash out refi or anything. What we're trying to do is avoid a cash in refi. We'd prefer cash neutral, where we don't have to put in $500,000 to get out. But we've been getting quotes. So let's say we owe, let's say $4 million. We're getting loan quotes at 2.9, 3.5 million, and we need 4 million to get out from under it.
So just doing a historical search, from March of 2022 to July of 2022, interest rates went up about 225 basis points, or 2.25%. So that's the expected return on, on the money for in regards to interest rate difference. And when you think about that, then many people, while it's not directly related, um, basis points usually go up in a pretty similar fashion.
Yeah. And I want to point out that this is actual percentage points for interest rate. It's not like interest rates only rose 2.5%. They increased 2.5%, which is actually like 200% increase, right? Or so,
I mean,
or
it's not a perfect
100%.
setup. You can have inversions of curves and everything else, but just looking at it broadly, that's just a quick way to look at it.
Yeah. But speaking with brokers and lenders, we are actually finding out one, a lot of people are in the same position we're in. Loans are coming due and they have to get out of them. And so a lot of people are doing cash in refinances. Um, some people are turning over keys, getting rid of properties because they can't afford to get out of it. And I try to coach my students on realistic assumptions going forward. But if I knew then what I know now, we would never have gotten this property because it's like, all right, well, in 4 years, you're not going to be able to get out from under it. And it's going to cost you everything and everybody's going to lose all their money. So yeah, underwriting is not perfect. You have to go with your best assumptions, but even markets are screwing everybody over. And I'm not saying, well, since everybody's screwed over, then it's okay. It's like, well, no, it's still not okay because you still need to work hard to figure it out. We are looking. We have a bunch of different plans going. We're trying to boost our performance, trying to get our NOI as high as we can, our net operating income, so that we can get a higher valuation. Um, but to get out from under that loan, we need 4 million at least, and that doesn't even cover closing costs. So
So I mean, with underwriting, you can't beat up underwriting. It's a great way to figure out what things are worth. It's not perfect. Just like there's once a decade events that there's no way to predict. There's international, and there's intranational, there's local events. There's a lot of things that can change the value and price of a property. Nobody could predict COVID. No one predicted the interest rates jumps. There are people in much worse shape because they were not figuring in that cap rate expansion that you're talking about. So the average person, when you sell a property, you're figuring a cap rate expansion of, like you said, 10 or 20 basis points a year. There are many people that didn't do that, so they're in much worse shape. And that's one of the reasons why some people just turning in keys. There's been a lot of foreclosures in the past few years of large multifamily assets. Um, they thought they had good underwriting, but somebody like Jason, you have like, what do you have, that list of the 7 red flags
yep.
and stuff like that. I mean, there's things that people took risks in certain areas because whether you like it or not, there's a balancing act. So you try to be conservative to protect yourself. Some people try to be a little more aggressive or they never get a property. So, I mean, you look at hundreds of properties a year. I don't think we've bought one in the last 2 years. Because it's a balancing act. If you're too aggressive, you're picking up every property you could possibly get, but then your return might be zero. You might be foreclosed on. On the flip side, if you're too conservative, you won't be involved in any deal and you won't be able to participate in any of the profit, any of the rent growth, any of the plans. I was with one team at one point, and they were so conservative that nobody wanted to invest with them because they were super conservative, even though it was a good deal. And when I say super conservative, I mean they're like, oh well, we only figured $100 rent increase, even though the property itself is $300 below market. And it's like you can do that, but you got to be honest where you want the interest rate, where you want the rents to be. They're like, oh yeah, we're gonna grand slam it out after we buy and after we close. It's like not if nobody's willing to invest in it.
So that's interesting because if they underwrote like that, and were they awarded the deal or no? Because I mean, ultimately,
They were awarded the deal, but they ended up failing the deal because they couldn't raise it.
so in that regard, what I would have done was originally keep those original numbers for buying the deal, and then increase them to see what it could potentially be at the higher rates. Even if they're assuming 100 and they're going to go up to 300 or whatever eventually, do it at the 300 just to see what it would be. And generally, I have more investors want me to cut that number back. So if the deal still made sense at 100, I don't understand why the investors wouldn't have wanted in on it, unless it was just like they were projecting IRRs of like 6% or something. But then if they boosted it up to 300 per unit, then their IRR could have been like 14, 15, 16. But
I mean, some of it has to do like when we think about underwriting, the concept of taxes, especially in certain markets, no one predicted how much taxes were going to go up. It went up beyond our underwriting, beyond what we expected as an oops, just in case.
yeah,
And same thing with insurance. Florida's been getting crushed lately. Um, we had a number of hurricanes in a row a couple of years ago, especially on the West Coast. Tampa, Sarasota area was hurt pretty bad, and that really changed insurance rates in the Florida area.
yeah.
Hard
And
to underwrite that.
when we bought that property that we originally started talking about with the lending issues, we bought it in December of 21. We closed in December 21. For those who lived in Texas in February of 21 would remember that snowmageddon, or when like the whole state was under freeze warnings, that killed insurance. That is the reason why insurance skyrocketed for us. um because they had insurance companies had to pay out so much for like broken pipes and stuff that they had to make it up somehow, and so they raised their premiums. A lot of insurance companies left Texas altogether, so that really limits on what you can do. um when we bought this property, we didn't see or project, yeah, we projected taxes going up maybe 10-20%. We didn't project 40% or whatever it was. It was significantly higher than anticipated. And granted, we did protest them. We hire a firm out of DFW to protest them and knock it back down. But if you remember our podcast on taxes, property taxes and non-disclosure states and all that, it's like you can potentially double your taxes and have like no recourse on how to get it back down in non-disclosure states like Texas. So
Yeah, so right now, I mean, we definitely across the country, I'm seeing higher cap rates than where we were 2 or 3 years ago. That's pretty expected when we have higher interest rates. Like I said, it's not directly related, but they do relate to each other in some ways. If people are expecting a higher return on their money, they're going to expect a higher cap rate to show that higher return. And then the one that you didn't mention that's really big right now is, we have debt service coverage ratios, but then they've been pretty standard for years, but now I'm seeing some of them creeping up.
yeah, so and yeah, I didn't mention this, but in our market, which is considered a secondary market per lenders, more like a tertiary market. in all respects. The DSCR requirement is 1.4 for us. If you were in Dallas, the same exact property in Dallas, you might be looking at 1.1 to 1.25
or 1.0.
or 1.0. Um, and depending on the loan, I've actually seen DSCR requirements of 0.75. I haven't really seen
That's
it below.
crazy to me.
I haven't seen it below that, but typically in that case, that's like a heavy value add plan where the bank knows you're doing heavy value add and they're anticipating it to be up above one in 1 to 2 years.
That's crazy to me, but to make you laugh, we actually passed on a deal like that recently. Well, I'm not saying we necessarily passed on the deal. We definitely passed on that lender. They were offering us sub one DSCR, and I said, guys, I am not willing to lose money on this property. I can't buy, even if we're fixing up, even if we're improving it, I can't take the risk of owing more every month just in interest versus what our rent collection was going to be.
Yeah. And for those that don't know, DSCR is the debt service coverage ratio, which is basically your net operating income over your debt service. So ideally you want your NOI to be higher than your debt service so that your NOI can pay your debt service. If it's less than one, that means your NOI is less than your debt service. So you might, for like a DSCR of 70.75, let's say your debt service is 10,000 a month. That means you're only bringing in 7,500 a month. And now you have to come out of pocket 2,500 just to pay the bank.
And when you say bringing in 7,500, that's bringing in 7,500 after most normal expenses.
Yeah, that's bringing in all your rental income, your revenue, other revenues, subtracting all your operating expenses, property management, utilities,
Yeah.
taxes,
But
insurance,
outside of
everything.
CapEx,
Yeah,
most normal operating expenses. Yeah. So, like you were saying with the snowmageddon, so the interest rate again right now, or whatever you want to call it, you have obviously insurance and taxes higher, so you have NOI lower than you expected. The banks are covering themselves with a higher DSCR. They already have a higher interest rate involved, and most markets have a little higher or a lot higher cap rates, which leads to low property values.
yep,
And some banks are very nervous, so that leads to lower, safer loans for a bank because it's a lower loan to value or loan to cost.
yeah. And it's not like we've been lacking or making our property do better. Our NOI increased over 100K per year in 4 years, 3.5 years. But with the cap rates, interest rates, DSCR, they're valuing our property lower than when we bought it, even though we've done everything we could to increase the NOI, and it did increase our NOI.
Even though
So
you're at 96 or 97% occupied.
yeah, we're totally stabilized. We're increasing rents as best as we can before people start pushing back and moving out. We increase our NOI, and now the banks are saying it's worth less than when we bought it, or worth the same as when we bought it. So I mean, everybody's fighting this situation. I see LinkedIn posts on this all the time. Other podcasts have been talking about it, but I mean, it's affecting everybody. It's affecting us. It's affecting big guys, like the big people who have like all thousands and thousands of units. I mean,
Oh yeah, we know people that I consider experts. If nothing else, some of them are a little smarter than me. If nothing else, some of them are more experienced than I, and they're still having a lot of problems right now in this market.
yeah, and that also goes back to it looks like mismanagement on the GP side, but it's not necessarily mismanagement, but it's like it's limiting distributions. It's causing a lot of investors to wonder what's going on, and that's like prompting a lot of lawsuits and everything too. It's like we're doing the best we can. We couldn't predict all this. If we did predict it, like I said, we would never have invested in this deal because it wouldn't have made sense. But we had the best information that we had at the time. We thought we were being conservative, which I still feel like we were doing pretty well. It's just the market conditions are killing us.
So what changes that? Interest rates obviously is a major factor.
Yeah, and cap rates do follow the interest rates. Typically, it's sort of like an indirect
Yeah, that's what I'm
relationship.
saying. Yep.
It's not like inverse; it's indirect. So, I mean, interest rates climb, your cap rates are going to start climbing eventually. There's like a lag in it. And actually, I did a LinkedIn post when interest rates were climbing. I did a plot on what your cap rate should be for a DSCR of 1.25 and 1.4 based on interest rates. Um, and taxes and insurance. I mean, so it's just everything is going against us. But one thing that we keep telling them, that we harp on, is real estate is not a short-term game. If you can weather this storm, you will probably find light at afterward. But I mean, getting through it is the hard part. So, um, you have anything else?
No, I mean, I think that's a good perspective of where we are. 3/4 of the way into 2025. I mean, a year ago, or yeah, if not at least at the beginning of this year, what did we expect? 3 rate cuts? Most people are predicting 3 rate cuts this year, and so far we've had zero.
I think our last one was what, last November or something like that.
Yeah, yeah.
And they're predicting another one, and by the time this pops and gets published, we might have another one in September of 25. um but nobody's holding their breath.
No,
People
like
are.
I said, in January, the markets had factored in, the stock markets and everybody else had figured in 3 rate cuts this year.
Yep.
And so far we're, beginning of 9 months in and we haven't hit that yet. So
So stay tuned. We'll keep you up to date on what's going on. um Again, this is second half of 2025 that we're talking. We're not quite into 3/4 of the year yet, but second half for sure. And just so that if you're listening to this sometime in the future, you'll understand where we're coming from. That's why I'm putting out there second half of 25. um yeah, I'd love to hear your comments, concerns on what you're seeing. Put it in comments, like, share, subscribe, all of the above. Give reviews for the podcast, it helps. And yeah, we'll catch you next time. We'll give you some more state of the market updates as needed. So this is Jason Williams with Ironclad Underwriting Podcast. I'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.